What's up everybody, Gen X Dividend Investor here. In this video I'll show you how much my $3.34 million dividend portfolio makes in Fidelity, both in the spirit of transparency and because I want to help motivate you dividend investors to see what's possible if you keep investing. Then I'll close things off with some troublesome financial trends I'm seeing, so I encourage you to watch until the end. Now I'm always hesitant to do videos like this because I recognize that many people are in very challenging financial situations and I don't want to come across as braggy or as unaware of others' realities. But the fact is that while I have a decent portfolio, I also have a ton of bad health stuff I deal with, so while you might be envious of my stocks, I'm probably envious of you being able to drive, or having a good memory, or being able to fully see things, or whatever else. So be grateful for what you have, especially your health. And with all that being said, let's dive in. This is a screenshot of my Fidelity account I took a few days ago on March 1st. You can see that in total I have $3.338 million worth of stocks spread across 3 accounts. It took me over 3 decades of investing to get to this point, with most of my contributions being small recurring amounts which have compounded and grown over the years, along with some bigger injections of cash whenever I got a bonus at work, or if I had any left over after selling a house, or etc. I've never been given any money or assets, or anything other than a refrigerator my parents got me when I got married. And actually when I got married I had a negative net worth due to college loans and credit card debt for my wife. My career started as a programmer and spanned a variety of positions in IT, though I never worked at the really cool tech places like Amazon or Google or any places like that. In fact, most of the places I worked at went out of business shortly after I left them, so either I'm cursed or lucky, depending on how you look at it. Anyway, I want to reinforce the message that you shouldn't feel disheartened if your portfolio is small or non-existent, and regardless, it doesn't make sense for you to compare what you have to what I have. What does make sense, and what does matter, is that you're actively watching investing videos like this one, and if you continue to expand your financial literacy, then I'm confident you'll do well over the long run. My goal is to help inspire and educate people to invest, not make anyone feel bad for where they might be at. Okay, back to Fidelity. You can see that I have about $1.47 million in my retirement account, $1.66 in my taxable account, and $214K in my wife's retirement rollover account, which I manage. I retired in my 40s a few years ago, once my dividend income was above my family's expenses, and now I do social media as a fun hobby, and because I'm showing my kids how they can start something fun online and maybe turn that into a career. Like my son loves to play video games, so I've been pitching that he should start streaming on Twitch, and I'll help him figure out how he can grow on YouTube and Twitter and all that jazz. Anyway, let's take a look at my portfolio. This is the first of 2 pages of tickers in my IRA account, and after this I'll show you a summary view of my portfolio in my dividend spreadsheet tool, along with some interesting details about my holdings. This is the default dividend view in Fidelity, and it sorts my tickers alphabetically, starting with a bit of cash I have in that account, which came from some dividends I recently got. I'm withdrawing almost all of my dividends to pay my family's expenses, but since I'm under age 59 and a half, that means I pay a 10% penalty tax on any early distributions from retirement accounts. But I was reinvesting my dividends for 30-ish years before I started using them, and I encourage you to avoid taking any cash out of your portfolio for as long as you can. I currently reinvest just a small portion of my ETFs back into themselves, and I'd like to slowly grow those positions more. Okay, the first ticker you see is AbbVie, and I have 247 shares in this account, and it yields $1,620 a year in dividends. You'll find that I often hold the same ticker in multiple accounts, and it'll be helpful to see the rolled up summary view of all my tickers in my spreadsheet tool, so for now I'll just quickly show you some basic stuff. After AbbVie in my IRA is BTI, then Caterpillar, Colgate-Palmolive, Chevron, Devo, Duke Energy, Goldman Sachs, IDVO, and JEPQ. About 10% of my portfolio is in things that are basically covered call income ETFs, and I'd be fine going a tad heavier into them. 100% of my CC ETFs were bought from profits from my existing stocks, so it kind of feels like house money, even though I probably shouldn't look at it that way. And note that each ETF has their own inherent risks that you should research if you're considering buying. I recommend people shy away from income ETFs unless they're in retirement or wanting extra income now, because those sorts of assets often have a higher likelihood of underperforming the market over the long run. I'd also resist the urge to go all in with them even in retirement, with one reason being that if we have a big market drop, then I think you'll probably see a material decline in your payouts. Of course, you can always find some time periods and edge case tickers which can outperform. Moving on, I have J&J, Kimberly-Clark, Coca-Cola, McDonald's, Altria, Realty Income, Pepsi, Procter & Gamble, Starbucks, SCHD, Southern Company, and ExxonMobil in my IRA, for a total of $1.466 million worth of stocks, and Fidelity estimates that in total they generate a little over $63,000 a year. And speaking of Coca-Cola, listen to this 20-second recent clip of Warren Buffett that I found really cool.
What was your first job?
It was selling Coke door to door, I believe.
How old were you when you first started selling Coca-Cola?
Either 6 or 7.
How many Coca-Colas do you drink a day?
Well, now I only drink about 2. When I was in fighting trim, which was for a lot of years, about 5.
5.
And I'm talking 12 ounces serving.
Nice. I've been a big Diet Coke fan for a long time, but my wife hates when I drink it because of its potential health risks, so it's kind of fun for me to tell her about Buffett and his Coke obsession and the fact that he's 94. I mean, obviously that means Coke must not be bad for you, right? Anyway, Buffett and Berkshire actually hold 400 million shares of Coke, which is about 10% of their portfolio, which means they're getting almost $800 million in dividends each year just from that one yummy stock. I personally make about $3,400 of Coke dividends each year across all my accounts, an amount which has been trending up over time. For example, take a look at the last 5 years of my Coke dividend payouts, and all the increases came just from dividend hikes, other than the first few months when I was reinvesting it. So in April of 2020, Coke paid me $665, then $671 in July, then $677, $683, $699, and it keeps slowly trending up until most recently in December they paid me $808, and with the 5.2% dividend hike they just announced, that means my upcoming April payout will be for $850. And that highlights the power of a quality stock that can keep raising their dividend like Coke has done for 63 consecutive years. I was making about $2,600 a year in Coke dividends 5 years ago, so nothing as impressive as Buffett, but imagine where things could be 20 years from now. And for reference, Coke returned $8.4 billion in dividends to share owners in 2024, and since 2010 they've returned $93 billion in cash. Okay, back to Fidelity. Next up is my taxable account, and this is the first of 2 pages of tickers. Here we see Apple, AbbVie, BTI, Colgate-Palmolive, Chevron, Duke Energy, Enterprise Products Partners, J&J, and Kimberly-Clark. Moving on to page 2, we see Coca-Cola, McDonald's, Altria, Microsoft, Realty Income, Pepsi, Procter & Gamble, Philip Morris, SCHD, Southern Company, and ExxonMobil. In total, I have $1.657 million worth of tickers in here, and Fidelity estimates that they generate almost $64,000 a year. Most of these are qualified dividends, but I also have an MLP and EPD, which means no federal taxes due for another 6 or 7 years, which is pretty awesome. I also have a tiny Realty Income position in here, but the bulk of my O is in my retirement accounts. I should also mention that I want some portfolio growth, along with sustainable and growing dividend income, but if I only wanted income, then I wouldn't own any super low yield tickers like Microsoft and Apple. I tell you that because sometimes I'll get a comment when I do these portfolio videos where someone will say that I could make a lot more money if I was in higher yield tickers, but I found that super high yield stuff often underperforms conservative portfolios like mine, at least over the long run. It's also true that my portfolio will probably underperform the market over the long run, unless we go into a period of market crashes or sideways markets. And if you're confused as to why someone would build a portfolio that they believe would underperform the market, then it's kind of the same reason why some conservative investors hold bonds or CDs or whatever. Basically, we purposefully sacrifice some growth potential for more income, as well as hopefully less volatility when the market crashes, amongst other reasons. I don't want to regurgitate all the reasons why I love to be focused on passive dividend income in retirement, but watch my other videos if you'd truly like to understand my reasoning. And like I always say, for most people the best bet is to just focus on broad market ETFs rather than individual stocks. Okay, now let's take a look at the rollover account, and then we'll jump into my portfolio spreadsheet tool. Here we see AbbVie, BTI, Home Depot, J&J, Altria, Realty Income, and Travelers Insurance for a total of $214K of stocks, yielding about $7,900 a year. So in total, Fidelity estimates my annual dividend income is $134,818, whereas my spreadsheet estimates it slightly differently, which I'll show you in a moment. Moving on, here's a screenshot of some recent dividends received activity in my Fidelity accounts to give you a flavor of things. So like the top one is a taxable account dividend from Procter & Gamble for $313. Below that is an IRA dividend from Realty Income for $772, and then $129 from Colgate-Palmolive, $405 from AbbVie, $33 from Realty Income, $204 from Colgate-Palmolive, $196 from Realty Income, $682 from AbbVie, $441 from AbbVie, etc., etc. My portfolio feels like it's an everlasting ATM cash machine, which just keeps paying out, though I know that the companies behind the tickers need to keep performing and staying true to their dividend in order for the money train to keep rolling on. I currently average over $11,000 a month in payouts, with most of my tickers coming quarterly, though some pay monthly. Okay, now let's take a look at my dividend portfolio spreadsheet tool, which is a tool that my Patreon aristocrats and kinks can use to input their own portfolios into for as long as they remain members. I've got this sorted from my largest positions up top down to the smallest, and this is the first of 3 pages of tickers. It color codes tickers green, like Devo is, if it's paying out today, so like in this case I took the screenshot on February 28th, which was Devo's pay date. It highlights tickers in light blue if they're paying out within a week, so like in this case J&J is paying out on March 4th. It highlights them in yellow, like O is, if it's paying out within the month, and they aren't highlighted if their next payout is over a month away. SCHD is my largest ticker, and I have 8,034 shares of it, and it is 6.86% of my overall portfolio, and it's currently worth $229 grand, and it pays out $2 grand a quarter, which is $8 grand a year. Next up is Realty Income, and I have 216 grand of that, and it pays out a little over $1 grand a month, or 12 grand a year. Then I have Altria at 212 grand worth, and it pays out a hefty 15.5 grand a year. Then you see AbbVie at 194 grand, and it's been a beast at appreciating, and it generates about $6,100 a year. Then I've got my EPD position, which generates over 10 grand of federal tax-free income each year, at least until my cost basis hits zero. Up next is J&J at 159 grand worth, and which yields about $4,800 a year. Then we see JEPQ, Microsoft, Devo, and ExxonMobil, where I have 134K of Exxon, and it yields about $4,800 a year. Moving on to page 2, we see Procter & Gamble, Duke Energy, McDonald's, and Coca-Cola, where you can see I have 118 grand of Coke, and it yields $3,400 a year, or $850 a quarter, like I previously mentioned. Then I have Pepsi, Goldman Sachs, BTI, PM, and Southern Company. Moving on to the final page of tickers, and you can see that I have about 100 grand of Apple stock, which yields only $408 of divvies a year, then Chevron, Kimberly-Clark, Caterpillar, Colgate-Palmolive, Travelers, Home Depot, Starbucks, and finally my smallest position in IDVO, which is the international version of Devo, and I have about 35 grand of it, which yields $2 grand a year. In total, you can see I have over 43,000 shares of tickers, and on the day I took the screenshot, my portfolio was up 1.2%, which is about 39 grand worth, and my total portfolio amount is 3.34 million, which is a teeny bit off from the Fidelity screenshot I took on a different day. You can also see that my portfolio makes $133,790 in dividends per year, my average weighted dividend yield is 4%, and my portfolio's average weighted dividend CAGR is 5.5%. And again, the slight disparity between Fidelity's income estimates and mine has to do with changing currencies along with how we each estimate annual ETF income. A comment I sometimes get when I show this part of my portfolio is from newer investors who conflate my portfolio's average weighted dividend yield with total return. So if you're sitting there thinking, you only make 4% a year, that sucks, then you're missing the fact that total return includes both dividends and stock appreciation, and the 4% listed here is only about dividends, and again, I've purposely built a portfolio that isn't only high yield tickers. Moving on, here's the first of 3 pages of my ticker dividend income from the last 6 months, and if I scroll to the right, it goes on for multiple years of history. Here you can see Apple, AbbVie, etc., and it lists the total dividends each ticker has paid out since I started the spreadsheet 5 years ago. So like in total, I've gotten almost $24,000 in dividends from AbbVie, and the most recent payout being last month in February when I got $1,528 worth of AbbVie divvies, and I got $1,444 in November of 2024, and the fact that the amount went up tells me that AbbVie did a dividend raise because I've not been reinvesting any more into it. If we go to the next page, we see another bunch of my tickers, and a quick scan shows you that Altria has been a big payer in divvies, having paid me over $52,000 just from it. Then we come to this final page of historical dividend income, and we can see a popular divvy stock in Realty Income and how it pays me a little over $1 grand each month. Down below, we can see that I've made about $500,000 in dividends since I started the spreadsheet. You can also see my monthly dividend totals on the bottom here. So like I got 10.7k of dividends in February, 9.5k in January, 13.1k in December, etc. And then this is a view of my dividend income by ticker, and it's sorted by largest position on top, and each column represents a month. The green column is the month we're in, which was the last day in February when I took the screenshot, and the 6 columns to the left of it are months going back in time, and the numbers are actual dividend income I've received. The columns to the right of the current green column month are estimates of dividends I should get in future months. And then this is page 2 of 3 of my dividend calendar view. And finally, this is page 3 of 3, and you can see the bottom total amount of dividends received per month for the last 6 months, which corresponds to that other view I showed you, which actually goes back 5 years and not just a few months you saw on screen. So this shows that in February I got about 10.7 grand of divvies, and in March I should get 13.2k, and then 9.3k in April, 10.9k in May, and 11.2k in June. One thing I dislike about dividend ETFs is that their distributions are volatile, which is something I don't like about international stocks either, only for international single stocks it's usually due to fluctuating currency reasons. Moving on, here's a chart of my dividend income over time since I started the spreadsheet. It's kind of fun and motivating to see divvy income trend up like that. And now let's move on to another part of my spreadsheet tool, which estimates what my dividend income growth will be like going into the future. The top row represents if I'm not dripping and I'm just continuing to get dividend increases, and the bottom row represents if I turn my drips on. So like the current year in both rows is where I'm at right now, which is an annual estimate of 133.8k of dividend income. 12 months from now, it's estimating that I'd be at 141K of dividend income, even without reinvesting anything, assuming my companies keep hiking like they have been. If I turn my reinvestment plans on during that 12 months, then instead it estimates my income would grow to 146.8K. Of course, the further you estimate out into the future, the less likely this is to be accurate. So for year 10, this estimates my dividend income would be 228K a year just from ongoing dividend hikes, or it could be at 324K a year if I'd been reinvesting that whole time. And here's that same information but in a graphical format, where the blue columns represent your income if your drips are off, versus the red columns which are if you're reinvesting, which visually shows you how reinvesting your divvies leads to faster income growth as time goes on. And here are estimates of my portfolio's dividend income growth going up to 30 years out, and just like you saw how Buffett's Coke income grew gigantic, mine could grow quite nicely as well. In this case, it estimates that 30 years from now that my no-drip income would be 668K a year, or 1.5 million a year if I had been reinvesting that whole time. One cool thing I should mention is that my portfolio is actually at an all-time high right now when I took this screenshot on Friday, at about 3.34 million. Another cool thing is this chart right here, which shows that my average monthly passive dividend income is $11,149, my average weekly dividend income is $2,572, my daily average is $366, and my average hourly passive dividend income is $15.27, which is pretty amazing to make over $15 an hour, even when I'm sleeping or watching a movie or whatever. Moving on, here's a graph which shows my portfolio percentage by sector. So like 12.4% of it is in ETFs, 6.5% is in real estate, 12.7% is in sin stocks, 10.6% healthcare, 11.2% energy, 11.9% is tech, 15.3% is consumer staples, etc. I'm low in financials and industrials and basically have no materials, though my ETFs would adjust things a bit. And then here's my passive income by sector. So my largest income sector is sin stocks at 20%, then I get about 14% from energy stocks, etc., etc. And here's my passive income by ticker, and you can see that MO is 11% of my dividend income, followed by JEPQ, then O is 9%, EPD is almost 8%, etc. And that kind of wraps up my portfolio overview. Now I'll switch gears and show you some troubling financial trends I'm seeing, all of which paint a picture of an increasing likelihood of a stock market correction or crash and/or a recession. That doesn't mean that will happen very soon or whenever, and regardless, I'm confident that good dividend stocks will weather any storm that is thrown our way. My hope is that you take the information I'm about to show you and you mentally prepare for whatever happens, because the last thing that I'd want you to do is to knee-jerk panic sell something that you might not want to otherwise sell. So let's start with the Buffett indicator, which divides the total market cap of all publicly traded US companies into GDP, and it hit an all-time high in the last couple of weeks. The average reading for the Buffett indicator has been 85% since 1970, i.e. the market cap of all stocks averages 85% of US GDP, but it recently shot to over 200%, which as you can see in this chart is an all-time high. And why does that matter? Well, because peaks in the Buffett indicator have often preceded significant market corrections, such as the dot-com bubble in 2000 and the global financial crisis in 2008. It also probably explains why Buffett holds more cash in Berkshire right now than he ever has held in its history. And there's a similar story for the S&P 500 Shiller PE ratio, or CAPE ratio. That one's based on the average inflation-adjusted earnings from the previous 10 years, and it's been backtested to January 1871. So over the last 154 years, the average Shiller PE reading is 17.2, but recently it's been over 35, which effectively marks its third highest reading during a continuous bull market, dating back to 1871. And why does that matter? Well, readings above 30 have historically foreshadowed pullbacks of at least 20% in the S&P 500. Another red flag right now is that consumers have pulled back their spending by the most in nearly 4 years. Basically, consumer sentiment seems to be bad due to widespread concerns about prices and inflation. In fact, as I was working on this section of the video, I got a notification that Target just sounded the alarm on declining consumer spending trends. And on top of that, we're seeing more negative sentiment about what tariffs will do, as that can lead to reduced corporate profits across the world. Combine that with this new GDP estimate from the Atlanta Fed, which a month ago was predicting almost 4% growth, but now it's predicting minus 2.8% growth. So that implies that the economy went from growing at a good clip to absolutely tanking, and thus instead of growing, we're shrinking, which you don't want to see. Now, it's important to understand that Atlanta GDP measure is not an official forecast, but rather a running estimate of actual GDP growth based on data as it comes in. But still, all that info I just shared makes it look like a recession is a lot more likely than previously assumed. Does that mean we will definitely have a recession this year? No, and it's important to recognize that. But it's also true that history often rhymes, so seeing all those indicators isn't that rosy for the market. However, each moment in time is unique, so the most important thing for us to do is not panic, but instead we should remain confident in our good, cash-flowing dividend assets to see us through this turbulent time, like they have for so many times in history. My goal is to get you to realize and internalize that the markets can and will eventually crash, and the people who aren't mentally prepared for that happening are usually the ones that seem to quit investing when the market finally tanks. I've lived through and kept investing through the dot-com crash, the 2008 financial crisis, and the pandemic, and in each case I saw how different friends and coworkers and acquaintances ended up giving up investing for good because they couldn't handle the drop when it came. Again, there's absolutely no need to panic or stress because every single time the market has fallen, it has invariably come back, and there's no guarantee that we'll have a recession or that things will crash this year. I mean, we could literally go another 10 years or even more before the market crashes, or it could happen tomorrow or whenever. It's also possible that AI and robotics are ushering in a new age of prosperity and growth that could translate into awesome stock market gains instead of a crash. Or both could happen. That being said, it also seems that AI is currently at a time of inflated expectations, so while I'm confident it will eventually drive massive new productivity gains, it's probably going to take a bit longer to get there. I mean, clearly AI isn't quite firing on all cylinders yet, as this AI-generated Coca-Cola ad helps make that point. Check out the Coke logo near the bottom of this picture and tell me that it doesn't scream that they used AI to make it. This was used in a Coke commercial apparently, so they might want to consider hiring better quality assurance to double check their AI-generated content before it gets out to the public. And that actually reminds me of a comment I recently got where someone said that only evil people would invest in companies that use AI to replace people's jobs. The unfortunate reality with most technological innovations is that they'll come with some good things and some bad things. My guess is that every company in the Fortune 500 is using some sort of AI these days, or at least what they're calling AI. And refusing to invest in them for something like that is something I don't agree with. Am I also correct in assuming that since you refuse to invest in them, you're also refusing to use the products they make? If so, then you're probably contributing towards them firing some employees as well. I mean, the companies in the S&P 500 employ something like 25 million people in the US, which is almost 20% of the total US workforce. Not to mention they also have employees working in almost all countries around the world. If those companies' revenues materially decline, then they'll be forced to lay off some of their employees. So your decision to not buy their products can also lead to random employees getting impacted, employees who are accountants or analysts or salespeople or whatever. Bottom line, you do you, but I feel like you're shooting yourself in your financial foot if you refuse to invest in a company for a reason like that. Yes, AI could take a lot of jobs. Heck, my YouTube channel will probably become obsolete as AI-based content shoots up through the roof, but I don't think me not investing in Google would materially change that technological shift. I'm pretty sure that in the not too distant future, it'll become common for robots to be walking on sidewalks and serving you your latte. I can see people snoozing in their cars as they're automatically driven, or maybe even flown, to wherever they're trying to get to. Some of these changes will help me, and some won't, and my plan is to invest in companies which can help create the future that we're going into. The key thing is to invest in solid companies, and remember that brilliant Peter Lynch quote that goes, "Everyone has the brain power to make money in stocks, not everyone has the stomach." If you are susceptible to selling everything in a panic, you ought to avoid stocks and mutual funds altogether, end quote. That makes sense to me as I found that success in the stock market is more about emotional discipline than raw intelligence, and your ability to avoid panic selling will probably be one of the keys to your long-term success. And with that, I ask that you please hit the thumbs up button, subscribe if you haven't yet, and click the bell notification. I'd like to recommend that everyone check out my Fast Graphs affiliate link along with my coupon code in the description of this video, as using both will allow new users to get 25% off their first payment, even if they sign up for a full year. I'll also recommend you check out my Seeking Alpha affiliate link, as new users often get benefits for signing up. Finally, please check out my Patreon page and/or consider joining my channel membership, as both have some cool perks you might like. Whatever you do, please don't forget to join my free Dividend Discord chat server, which has over 11,000 dividend investors on it from 84 countries around the world. Thanks for watching, stay positive, and I'll talk to you again real soon. Remember, I'm not a financial advisor, and my videos are for entertainment and inspirational purposes only. Investing of any kind involves risk. I'm only sharing my opinions with no guarantee of gains or losses on investments.